on the market. Aman Chauhan is with us from Abacus Asset Management. Aman, good to have you with us here. Thank you very much. We're speaking at a time when the market had a very sharp run-up. The last 2 weeks, there was the local event of elections, and then there was the global Fed change in direction. This week, the rally continued, except that one day, a day before, when we had a bit of a scare. How are things looking now, Aman, and what have you been doing at Abacus?
So we have been gradually deploying cash, holding that we had, and taking all the opportunities in the market whenever there is a correction. We are using that correction to deploy cash. Frankly, there is not much of reason to be fearful in the market, except that it has run up too fast in the near term in the last few months. But if you look at any economic numbers, if you look at any data point, things are looking good from a local perspective. Till the time global events don't scare us, I think locally there is nothing to be fearful about, and hence we remain optimistic on the market. Just that this is not something which is a very cheap market. It is a fair market zone, a fair valuation zone, and hence from here on one should be careful in deploying capital, which I have been doing. So we are like gradually deploying capital using corrections like the way it happened a few days back to commit more capital is what the broad strategy has been.
So do you want to tell us, this week we had that big fall. Which were the themes where you did deploy money?
So incrementally in the last 1 month, we have deployed the cash into renewable space. We have deployed cash into buying companies in the engineering space. And we continue to remain positive on financials. So that is where the bulk of the incremental money has gone, especially in the last month or so.
Okay, all right. What about the metals theme? You all have got it right on numerous occasions. What's the view out here? The reason I ask you, Aman, is because China, if it bounces, the spreads are at record low levels and they're exporting big time. If both of them turn around, that could be an additional fillip for the ferrous space. Your view?
So we are very selective on the metal space. It's a global commodity, and hence we feel that we are not experts in the global commodity front, and hence we have a limited exposure. We have a positive on metals. Metals currently would be, say, high single-digit exposure in most of our funds, and we are comfortable with that holding. So even 6 months back, we had a similar exposure. As we speak, in spite of the price going up, we are maintaining those kind of exposure in the metal segment. And the view remains the same. There can be a potential upside from China coming in, and that's the reason we continue to stay invested in this space.
Aman, one of the things one can I'm just sort of referring to some of these moves that we're seeing, right? Wipro, for example, is sharply higher. Are you as you look into 2024, look at what else to do, etc. It's hard to find stocks which have not done well, right? Is that one way to go? Are you doing that when you look at themes, etc.? I mean, what to buy? Maybe relative underperformers. There were many of them as we came into 2023. As we exit 2023 across sectors, there is not very much. So just wanted your thoughts there.
Sure. So what happened in the utility space a few months back is a classic example of relative underperformance, where the sector had not moved and hence people came in and it got re-rated. It's a bull market, so this phenomenon I think will continue in the coming year also. So wherever there is relative underperformance, for example, chemicals. Chemicals as a sector has not done well over the last 12 months. And for the reasons that we all know, that there has been earnings downgrade in that sector. So has been the case with IT. So I feel that these two sectors in the next 1 to 2 quarters, once investors start to see things bottoming out or starts to look up, they'll start and come to participate. IT has in general, post the last few days once the Fed meeting happened. But chemicals is something that can definitely we can look at these levels. And even financials, large cap financials, the large banks, HDFC banks of the world and the big private banks, they also have relative underperformance. So that space is also looking good. So while broadly financials have done well, the mid and small cap banks have done well, on a relative basis, the large cap banks are still offering value and some bit of catch-up rally still pending there.
In chemicals, Aman, is it just a tactical bounce that you're hoping for, that you think will happen, or has it turned the corner in your opinion? the big issues of too much inventory and prices, dumping from China, all that we've turned the corner there?
Yeah, for the chemical is almost there. Though it will remain volatile, we're not going back to the previous highs. But even if they recover from the current levels, I think there is money to be made in the sector.
What about insurance, Aman? There is this new proposal, a draft policy by the IRDAI, where they're looking at higher surrender charges. And if it does come through, it will hit the margins of insurance companies. And stocks have struggled over the last few days, fearing that. Would you be fearful of insurance? Were you holders, investors in insurance companies? Would you look to pare it down because of this development, potential development?
So currently, we are exposure only under the life insurance segment. We are not in the general insurance, and within that also, this is a mid-single-digit exposure that we have. So we are also keeping our eyes and open as to how things develop. But for now, staying put, not taking any specific action in the sector as such.
Okay, Aman, I wanted your view on these PSU themes. I'm going to put out a piece in the next couple of hours on the channel itself that the entire PSU basket put it together was 15 lakh crore. That was close to around 3 years ago. And today it's 50 lakh crore. So you'll say, wow, it's gone up by such a great deal. But the story is like this, that the profitability has gone up by far higher multiple in comparison to what the market cap has gone up by. How would you approach this space?
So clearly this has happened because there has been a clear government focus to revive many of the sick PSUs, to improve their profitability, to get in management, get them listed, make it professional, and that is what is getting reflected into the profitability, and the re-rate in the market has happened. So one, there was obviously a relative valuation gap between the private and the PSU sector, and few PSU names have also done well. The way we approach this, we are selective in our PSU exposure, so we don't have exposure in the segment where government is in total control, where the orders as well as execution, everything is in government control. We would like to get into a PSU where government is hands off, or they just have a majority or a minority holding, and not the complete business is dependent on government. So classic example is PSU banks. So we do have exposure to PSU banks. We don't have much exposure to PSU defense, because in that the whole supply chain is controlled by the government. That is too much of a risk to take. It made sense at single digit P, but now with 30, 35, 40 P for most of the PSU defense stock, it doesn't make sense. The risk reward is no longer favorable in that segment. So we are pretty selective in what we do. We also like the space, but so far it's been more of PSU banks for us and selective small exposure again in the other PSU names. And I think in the near term, we'd like to maintain this stance.
Aman, another bullish bet which the market has taken is on capital market plays, whether it's exchanges, wealth management companies, AMCs, and stocks have done phenomenally well, re-rated completely. Would you bet on them at these levels, or do you think the markets have priced in too much?
I would bet on these. So non-fund-based financials as a space is something that we like. In fact, in the last month or so, we would have increased our exposure to the wealth management companies. And the space is still looking good. These companies will be trading anywhere around 20-25 P multiples versus the, you can say, other sectors which are upwards of 30-35 P. So there's still scope and to go well with this sector. And if market continues to do well, there's a, you can say, an operating leverage which comes in, there's profit growth, and the multiple also goes higher. So it's a perfectly high beta, you can say, sector to be in. And being high beta, we are also very selective, right? So we just increase our exposure, and that is still, say, low single digit that we have. So we are not going to have a very significant holding because it's a high beta sector, but it's still looking good. And that's the reason we added on to this segment in the last month or so.
And there's still upside, according to you, in these. You're looking to raise your exposure further from the mid-single digits?
Marginally.
Marginally, okay.
All right, Aman, we'll leave it there. It's a pleasure having you with us, speaking to you. Have a wonderful holiday. And of course, if we don't speak before the end of the year, into the new year, wishing you all of the best to you, your family, and of course to the Abacus team as well, from all of us here at CNBC TV 18.
Great. Thanks for hosting us, and wish you all the same.
Thanks very much, Aman. Well, 100 plus points on the Nifty is what we have, and 21,360 exactly, that level where the market was earlier, which is, of course, also that 61.8% retracement exactly there as we get into the fag end of the trade today and this week as well. 20 minutes to go, 25 minutes to go for market closing. We'll take a quick break here. and we'll come back. We'll come back and tell you what to buy or sell today for a reverse trade when we come back on Tuesday. Monday, of course, remains a holiday. Stay with us.
CNBC TV